Hey, good morning once again, options traders, and welcome back, everyone. Well, we got another good question from one of the traders in our very own group right here. And the question is, are debit put diagonal spreads a good way to harvest premiums? And I like this question because I just talked about this in the last video. It's got that word good in there. Remember, as options traders, you've got to get the words good and bad out of your head. No strategy is good, no strategy is bad. They are just tools. And under the right conditions, they can be good, but they can also set very dangerous traps. So let's go find out some of the technicals here of the potential pitfalls for diagonal spreads. As always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is very much appreciated. So let's start off with the types of spreads. So whenever we're talking about spreads in the options market, you are going to be long one, or at least long some type of asset, and short another. For options, it usually means that we are long an option and short an option. And so within this category, we have three main types. We have diagonal spreads, where you're going to have different expirations and different strikes. So for instance, you might buy the March 100 call and sell the January 105. Different months, different strikes, that's a diagonal spread. There's a vertical spread, where we have different strikes but the same expirations. So maybe you buy the January 100 and sell the January 105. That's a vertical spread. And then finally there is a time spread, also called a calendar spread, where you have the same strikes but different expirations. So maybe you're long the March 100 call and short the January 100 call. Now you're probably thinking right off the bat, why are we talking about verticals and calendar spreads when this is primarily about diagonals? Well, the answer is that diagonals are part vertical and part calendar. And this is where some of the problems can lie. So where's the first one? Well, it's with skews. There is what's called a vertical skew, where you are plotting various strikes for a given month. And then there's also a horizontal skew, also called a tilt, where you are plotting various months for a given strike. And so these skews really can wreak havoc on vertical spreads. So for instance, let's say that you buy the October 50-55 call spread. Well, traders often sell at-the-money options since they're the ones with the most time value. And again, they get this idea of good and bad in their head, and they say, oh, if that's the one that has the highest time value, it's the one that's premium rich, that must be the best one to sell. Not necessarily. It can be a problem when skews are present. So for instance, let's take a look at some options. And here we're looking for a given expiration. Just for December, these are various strikes. Depending on your platform, these might be all calls, they could be all puts, or they could be a mixture. Thinkorswim allows you to look at all three. But let's say that this is the at-the-money strike, the 50. In an out-of-the-money layout, the higher strikes will be the calls, and the lower strikes will be the puts. So you're actually looking at a combination. And when you do that, this is very common. Theoretically, if the stock is trading at 20% volatility, each of these strikes should also trade at 20% volatility. After all, they're covering the same underlying stock for the same amount of time. Doesn't really make sense why they should have different volatilities, but in the real world, they do. So here's what we'll probably see in the real world. We might see the 35 put trading way up here. We might see the 40 trading down here, 45 down here. The at-the-money will trade very close to the volatility of the stock. There's an arbitrage available if that's not true. So that will almost always be touching that line right there. And then as we go to the out-of-the-money calls, we start getting these skews again. And so we get this little smile, and that's called a volatility smile, which you've probably heard of before. So here's the problem for vertical spread traders. If you're selling the at-the-money because you think that's the good one to sell, well, in the presence of a skew, if you buy the 45 and sell the 50, look what's happening. You're paying for a higher implied volatility, selling a lower implied volatility. That's not good. That's an edge acting against you. Coming from this direction, you get the same thing. If you buy the 55 call and sell the 50 call, you have an edge against you. What if you go this way? Now you're buying the low volatility, selling the high, even though you're buying the at-the-money, which most people are going to say that's not good. It depends. In the presence of a skew like this, it could be the best way to set up the trade. What if we maybe skip a strike? Fine. You're buying the low volatility, selling the high. We can go in this direction with the puts, buying the low volatility, selling the higher volatility. Those would all give you a mathematical edge in your favor. But the connection that you have to understand with the diagonals is that a diagonal spread, again, is a combination of a vertical spread and a time spread. And there's a mathematical connection that I teach traders is that it actually holds. It's an actual equation. Diagonal equals the vertical plus the time. This is not just a figurative formula. This is really the connection that exists in the real world. So for instance, let's say that you have the diagonal spread. You buy the March 100 and sell the January 105. This is a long diagonal spread. And then if you sell a time spread or a calendar spread, so you're short the March 100 and long the January. So you're short the longer dated option. That makes it a short calendar or a short time. And look what happens. These cancel. And what are you left with? You're left with a short January 105 and a long January 100. That is the January 100-105 vertical. So if you own a diagonal and spin off the time or sell it out, you're left with a vertical. You could also sell the vertical, be left with a time. There's a connection in here, and this is really important to understand for diagonal spreaders. So here's another way to visualize it. Here's an options chain with various expirations across the top and strikes on the vertical. Let's say that you buy the March 50 and then you sell the January 50. Notice that we are operating horizontally here or spreading off the months of the calendar. This is a calendar spread. Different expirations, same strike. So this would be long a calendar spread. But then what would happen if you bought the January 50 call and sold the January 60? That's a vertical spread. We're operating vertically now. But look what happens. You're long and short the January 50. See that red and green circle right there? They cancel. And when they cancel, you're just left with a diagonal. So the thing that you have to understand is that to do this diagonal, we also have to check the pricing relationships of the calendar and of the vertical. We need to make sure that this little triangle right here is in balance. So just because somebody says that a diagonal spread is a good strategy or that you always sell the at the money is simply not true. That can get you trapped. So once again, to answer the question, is a diagonal spread a good way to harvest premiums? Remember, there is no good or bad. Good strategies have a mathematical edge, and this is where you have to understand some of the pricing relationships and the natures of the strategies. So let me show you one last thing to consider, that there are really 9 basic combinations between price and volatility. So if you have a bullish outlook on price, you think the price is going up, and you think volatility is going up, yes, you can take a long call, get the positive gamma working for you. But if you're bearish on price, but bullish on volatility, you would want a long put. Again, get that positive gamma and vega working for you. If you're bullish on price but neutral on volatility, take the long stock, delta 1, gamma 0. What if you're bearish? That could be a short stock position. What if you're bullish on price but bearish on volatility? That could be a short put. Now we want negative gamma. What if you're bearish on price and bearish on volatility? That would be a short call. Again, negative gamma, but we would at least have negative deltas. What if you're neutral on price but bullish on volatility? We just think volatility is going to rise, but we're not really sure about the direction. Well, that's where your long straddle comes into play. If you're neutral on price, again, meaning I don't really have an opinion on whether it's going up or down, it could go either way, but I'm bearish on volatility, I think it's going to fall, that's where a short straddle would come in. But finally, if you are neutral on price and neutral on volatility, this is the only time you should take no position. There's no reason to do it. There's no reason to expose yourself to price and volatility changes if you have no opinion on them or have no mathematical edge. So this is really another insight that I often teach traders when they're talking about diagonal spreads or some of the more advanced strategies. They lean on these strategies because they hear that they're good. Always remember that they're tools, and whether they're good or not depends on how you're using them. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.